Your thoughts on the session?
James, look, certainly, as you mentioned, a very positive session to end the month of September for what we did see. Quite a volatile month, as you mentioned, down about 6%, really led by those financials and materials stocks. And we really did see that theme continuing on the market today. It was quite a volatile day, but a positive one in the end. We did see at the start of trading today a fairly negative start, particularly off those weaker leads from overseas markets. And, of course, that falling iron ore price, which is continuing to add pressure on that materials sector. We actually did see Atlas Iron, the worst performer, down about 5.6% in the end. But we actually did manage to find some support during the day. We did see that flash manufacturing read coming through from China, which I think has provided a bit of a boost to investor confidence ahead of the official read, which is out tomorrow. And we actually did see quite a nice turnaround in that materials sector, which did end up closing in positive territory. We also did start to see some support coming back into those financials and banking stocks, as we have started to see a bit of profit taking over recent weeks. And of course we did see that consumer discretionary area performing quite strongly off the back of quite a strong weekly consumer confidence read. So overall it was certainly a positive session, but unfortunately did finish the month of September in negative territory.
Your thoughts on the outlook for the banks?
James, I certainly agree. I do remain optimistic on the outlook for the banks, particularly for those investors that are holding the banks for those high dividend yields. Of course, those mum and dad investors and those self-managed super funds as well. But having seen the banks pull back, as Mike mentioned, over 10% from their peaks, I do think that we can potentially expect to continue seeing a little bit of volatility coming out of that financial sector, particularly if we do see volatility continuing on the market in general. And I do think the Aussie dollar is potentially going to have a big impact on that. We know that the Aussie dollar is continuing to fall in the wake of falling iron ore prices and, of course, a strengthening US dollar off the back of a lot of strong US economic data coming out of there. So if we do continue to see weakness in that Aussie dollar, I think a lot of foreign investors are continuing to pull out of a lot of those high-yielding stocks, such as the banks. They are starting to sit on the sidelines a little bit now. So I do think if we do continue to see those falls, I think we can expect to continue seeing a bit of volatility in those financial stocks. But certainly looking at a long-term view, we actually do remain pretty optimistic on all four of the major banks.
Leanne, it's Mark here from the NAB. We had on last Friday's show Rudy from FN Arena talking about the banks and saying like he thought that was a great opportunity to buy, but he was conscious of the fact that there was more institutional selling, but he couldn't actually put his finger on, why it was just the market scuttlebutt. Is there a way to, as an investor, look for some sort of signs that you can give you some currency around the fact that you think it's this international seller? Because sometimes the market gets a view of itself and it becomes somewhat self-fulfilling, if you like.
Mark, I certainly agree. It is pretty difficult to tell where that selling is coming from, but I think the sharp falls that we have been seeing, I think, definitely can be put down to a lot of institutional selling. As I said, I think a lot of private investors and those self-managed super funds are certainly holding on to those banks for their dividend prospects. So I think it certainly becomes very difficult about judging when to buy into the major banks. But I do think any dips that we do see, we often do think is a good buying opportunity, even looking at the market in general, as we have seen a big pullback. So looking at the banks, I think if you can focus on the underlying fundamentals, which still remain very strong, I think investors looking at this dip that we have been seeing, I think could be potentially good buying opportunities.
Leanne, second day in a row, one of the worst performers. Linus off by about 7%, albeit, I mean, it trades at about 8-9 cents at the moment, so percentage movements always look a bit exaggerated. But market's still concerned about capital raisings.
That's exactly right, James. Seeing that share price certainly continuing to come under pressure. Yesterday they announced further detail around that equity raising, but I certainly think there are a lot of long-term concerns, and I think investors are certainly pretty nervous about the outlook for this stock. We know it has been in focus a lot lately about renegotiating and refinancing a lot of their debt, and of course this equity raising is actually going to help them make that next repayment next month. But yesterday we did actually see investors reacting pretty negatively. We saw that equity raising coming on at a pretty steep discount, a 30% discount in fact to that last traded price, and we also saw a full year loss coming through, which had actually tripled. So certainly those two reasons has added downward pressure on the stock. I think broadly there are a number of concerns, particularly particularly looking at their balance sheet and their cash flow problems, which really do remain a big concern. Their gearing is very high and they are barely cash flow break even at this stage. So I think that certainly adds a long-term uncertainty for investors. They have very high costs at their Malaysian refinery as well, which is certainly adding pressure on their earnings outlook, and also having a look at those rare earth prices, which are continuing to fall as well. So I certainly think all of these factors combined, investors are pretty uncertain about the future outlook, and certainly seeing that share price coming under a fair bit of pressure.
All right.